disability income. It's underpriced, it's under-reserved, it's overspec'd, and it's costing our shareholders money every day. My name is Brad Louis. I'm head of pricing at Munich Re. We've just completed our biggest ever experience analysis, and we thought it was essential that we come and share that with you today. Let me briefly introduce the people who will be helping me. So Wallace, Lee, Graham Kelly, and Alex Threlfall. Wallace is our resident disability income guru. He's had his head in the analysis for quite some time, probably to the extent that we'd be lucky to find someone who knows more than him about what's happening in disability income at the moment. Graham is one of our actuaries. He's actually a deep thinker on a lot of things. When we made the choice that we needed to stop using the IAD table, Graham made sure that what we came up with worked, essentially, and made sense for us going forward. And Alex is not an actuary, so it's great to have him. Alex is part of Munich's R&D team. She has a passion for building products that are sustainable, and she knows a hell of a lot about disability income products. So what are we going to cover today? I'm going to start by talking about where we think the industry is at. After that, Wallace will share a little bit about the analysis that we did, but more importantly, what the insights are. Graham was then going to cover what we think is a really important area, which is what are the barriers to action, both in the past but also going forward as well. And then Alex will share with us some of her views on what a new product might look like that we think is more sustainable and work for the industry. We expect that as you go through, we hope you do, we'll have questions. Please take note, we'll have Q&A at the end, and we're looking forward to hearing what questions you have. For us, this is an important section to have, completing our analysis. So for us, this is an important session. Having completed the analysis, we've needed to make some actions for Munich Re, and I think the industry needs to make actions too. And so that's why we're running this session. So let's get on with it. So where are we at today? Over the last 5 years, there's been a lot of noise about disability income and how it's tracking. Whether that's listening to the profit announcement for all the different life companies, whether it's reading CEOs of various companies making comments in the press that we all need to put our prices up by 30%. So there's a lot of noise. And if you look at the APRA stats, this is retail disability income. You can see for the last 5 years that profits have been generally falling. And particularly in the last couple of years, are obviously not very good, particularly as a lot of us, our assumptions have caught up to the experience. When I first showed this graph to some people in the last week or so, they keep saying that it's ticking back up. And my response was, that's not Munich's view. We think this is a one-off and there's plenty more pain to go. I've actually just found out that the APRA stats released in the last couple of days show another pretty negative number. And even despite that, we think there's still more to come. It's not a great picture for the industry. And certainly if you're an external person looking in on the industry, listening to all the chat, listening to the companies talk about disability income in their profit announcements, you'd be thinking, wow, they must be really doing stuff to fix this problem. So what are they doing? What are they doing on price? What are they doing on product? So let's have a look over the last few years. What have we been doing? So price first. If I start in 2008, when we probably started to talk about the problems, and I say that the average industry price is benchmarked at 100, what's happened over the last 5 years? So this is for the industry as a whole. So 5 years, when the industry's been talking about concerns with disability income, there's been next to no movement on prices. So 5% across the whole 5 years, about 1% per annum is how the industry's been tracking. So not a lot on price. And if you go to the next layer and look at the 12 main providers of disability income, I actually find that even more interesting. So it's a busy graph, but this shows, compared to where they were pricing in 2008, how companies have changed. So 4 out of the 12 main riders have reduced prices in the last 5 years. The majority of the rest have done very little, maybe a little bit of increase, and yes, there's 2 outliers. Most of this industry will know who the outlier in red is at the top, and I'm sure they're sitting asking the question, why doesn't the industry follow? And Graham will talk a little bit about barriers and why that may have happened. And if I take out those 2 top outliers, on average, the industry has reduced price over the last 5 years. So clearly, collectively, we're not doing much. So maybe we've done something on product. So if I think of tightening, what has the industry done in the last 5 years? So, yeah, not much. So this is a wide count of the number of industry-wide product tightenings that we've implemented over the last 5 years. And I've got to say, I feel quite generous putting this one on because this one is the one that APRA mandated the changes to super definitions last year. And so, of course, while this is happening, other things have been happening on product which are definitely not tightening. For example, today I can get a standard rate with a BMI of 35. 5 years ago, I couldn't. I had to be 32 or under. Today I can get significantly more cover than I could have 5 years ago. And today I can get more cover with no underwriting than 5 years ago. So the product and pricing, collectively, as an industry, we haven't been taking action. So where does that leave us? If I go back to this APRA graph that I showed you, this is a graph of the in-force profitability. And we thought about how do we convey what we think needs to happen to reserving and pricing. And in reality, it's easy to talk about new business. So having completed our analysis, where do we think profitability of new business is for the last 5 years? So the red line turns up. The red line shows, from Munich Re's view, we think the industry is making losses with every new policy that we sell. Now, of course, we'd all love to be making profits, wherever that is, and every company has their own targets. So then the question is, how big is this gap? So I needed to make some simplifying assumptions, and I can go and look at, for a standard portfolio, how much they charge on average, and I can understand what we believe the claims cost truly is. And if I make a simplifying assumption that the rare company needs to make a loss ratio of about 50% in their profit targets, so after allowing for commission and expenses and profit margins, then that tells us that the industry needs to increase prices by at least 20%. And I say at least because when I did this, I wanted to be a little bit conservative, not overstated. So I guess as an opening commentary, the last 5 years has been a lot of talk, but not seemingly much action. We believe that's left us in a position with significant work to do. And there's one number to take, certainly from this introductory section, it's the 20% plus that we think. So of course, you're probably now wondering, well, how do we come to this views? This is where I'm going to hand to Wallace. He'll talk a bit about our analysis, but more importantly, insights.
Lots of stuff. So I'm here to share some insights. These insights aim to improve our understanding of disability income, help us price better, and reserve more accurately going in the future. There's a few insights I want to share. First one is how sickness incidences have changed over time, how accidents incidents have changed how sickness incidences have changed by policy duration, how accident incidents have changed over time, and how termination experience have changed over time.
Sorry, we're having a problem with our mic, so you could stand there. You know, that'd be better.
Yep.
Thanks.
So before I can hear better now? Yeah. So, hold the mic anyway. So before I get into those insights, I want to explain how we came up with them. So back in 2013, we did our usual analysis, compared our actual experience of incidence termination against our expected table. Looking into it, we go, hang on, some of these insights don't make sense, and then we kind of drill down kind of why we're having those uncertainties. It's our expected table. It's our IAD 8993. As most of us here know, those numbers mean it's the year that the experience is used to create that table. It's 25 years old. I'm just not sure how many of us in this room actually drive the car regularly that's that old. Like most things that old, they don't work very well. IAD is no exception. And we're relying on this to standardize our different demographics within our portfolio. So age shapes, our claim duration shapes, our relativity between waiting periods, occupation, they all have changed in the past. I just want to share one quick example, and it's how our incidents by age have changed as compared to this IRB table. I'll be using this kind of structure in the inside, so I just want to take a brief moment to explain what it's trying to show. So where the blue bars meet, that's the actual experience from our investigation compared to 100% IAD. The height of those bars are its 95% confidence intervals. What this is trying to show is this IAD table is not very good at modeling the shape of our experience. It's understating our incidence at younger ages and overstating it at older ages. So if the IAD models it accurately, you should have a pattern that goes quite flat across the page. Now, I'm not suggesting anyone here uses this 25-year-old table as is. There's actually, we make adjustments to things. Now, the problem with DI is that there's so many factors, and all these factors all relate to each other. So how many adjustments do you really need to make sure you allow for all these correlations? I don't think I'm telling anyone anything new here. Industry understands this, and that's why we're getting an industry investigation, and we're getting a new tables coming soon. MRIP just couldn't wait for this table. We wanted to really understand what's happening with our disability income experience, and this is what we did with ID. We threw it away. It was very scary at first, actually, because that's not the table we've always had, as long as my career has been. It's the only thing that's been around. So chucking it away was terrifying at times. So what did I have to create this new standardized table? We have our investigation, our experience investigation. Munich is in a relatively unique position here, where we reinsure a large part of the portfolio market. We also, for that part of the market, we see every single claim in every single claim. And how we designed the experience analysis was, it's a 10-year investigation. It's from 2004 to 2013. How all these three things get combined is, we get a lot of data, and we see the cycle, the 10-year cycle. So for incidents, we have about 19,500 incidences and 15,500 terminations. So I talk about all these relativities between all these factors. That volume data just allows us to slice and dice them. Well, that's all good, but we do have a lot of data. What do we do with it? I still don't have any cable. First, you have to understand the drivers experience. When we talk about drivers, we talk about what drives our experience. We know age is a driver. What about by cause? By say cause, I mean accident, sickness. What about by waiting period? So what we started doing is, we did a two-way analysis. We made sure, okay, what drives age? Is it accident, sickness? Yes, it is. Is it waiting period? It also drives your shape. We're going to start building this up in more detail. We go, how about a combination of cause and waiting period? So we did three-way analysis. It's slowly building up and up and up. We're only getting about 5 to 6 way analysis. This is what we found. The cause, the waiting period, occupation, and the gender, they all drive the different A shape. So that's effectively 16 different segments. So looking at white and blue collar, 30-day max. There's other factors that doesn't drive the age, and they're things like your benefit period, your smoking status, and your agreed value indemnity. Some of the factors. One of the insights I've shared is about how incidence experience differ by policy duration. Policy duration actually very correlates with this cause and the waiting period. So now we go to drivers, we can start creating our new table. This is a table that we're going to use to share these insights. That's where they come from. So the first one is about sickness incidences and how it increases by policy duration. The expected table that I'm going to show is a table except for the claim duration adjustment. We basically don't standardize our duration so we can see what shape it has. And this is what we see. The only new thing I've introduced is this dotted red line. It's just a very simple line of best fit on the A over E's. It's not supposed to be aimed at set this way the actual screen should be. This is not working on selective lapsation. Basically, people who decide to stay, they know something that they just can't get covered elsewhere, so they have worse experience. This applies to all more granular segments. They apply to a 30-day, apply to a 90-day, and it also applies to your white and blue collar. It's different degrees, but this pattern, this increasing pattern is seen for the whole across sickness. Now you might ask, okay, I've shown a sickness slide. What about accidents? Accidents, we're not actually seeing this pattern at all. That dotted red line is actually quite flat across that page. There's a little bit of anti-selection, and we're seeing it for the 30-day blue-collar accident points. It's a very mild one, so I'm not going to cover that off in any more detail. Back to this sickness trend. Now you might wonder, hang on. Early duration. It's a brand new spanking product. It's got a underwriting engine. It's got a distribution straight. Of course it's got better experience. Now you think about all the older policies. That's a legacy product. It's got lifetime, it had bad underwriting in the past, we corrected it since, it's got bad distribution. I mean, there's lots of reasons why we think the legacy is worse. That's why we thought initially at first when we created this table, we thought, okay, let's analyze this new and old. But when we looked into it in more detail, that's not the reason. It's this sickness duration impact. Now imagine you're pricing actuaries or valuation actuaries, or just trying to get a sense of how you price in the future. Assuming you're not adjusting by policy duration, I got a trend for new business. It's down low, and that's what your experience investigation will show. Imagine that book ages, slightly higher. What do you need to do? The experience analysis showing, hang on, the experience is worse. I've got to put up my pricing and put up my ruler. And that will continue as that ages. One thing that conveniently mentioned just then is, hang on, coming from the left side, there's all this new business coming through. So that effectively tempers your average duration. Now, that's assuming if you price your average duration, you're assuming your new business and your lapses kind of offset each other. Which might be fine at first. But what if the new business volume changes, or the lapses change? My question is, how comfortable and how transparent are we that we're exposing ourselves to the need to have this constant stream of new business. In an extreme view, and it's hard to imagine at the moment, what happens when this book that's open to new business closes? It will close someday. How are you going to price the reserve rate then? Looking at the slide and the title, I can really put the numbers. It's a numbers trend. And that's consistent with the industry analysis. It's on a numbers basis. What I'm going to show to you is, by amounts, it's actually significantly worse. But first, using this red dotted line as a guide, the bottom point to the top point is differ 53%, about 50%. So, quite a significant trend. So basically, the industry table will have, to our understanding, have adjustments for this policy duration. But if you look at it by amounts, which I'm going to show, I kept the scale exactly the same. It shows the significance on C. That's something we have to adjust for when this table comes out. And as mentioned about the 50% gap, let's do something similar. It doubles that. These aren't small numbers, so it's definitely something that is worth noting that needs to be adjusted when the industry table comes out. That's the first insight. Second one is about accident incidences and how it changes over time. This time, the expected table here is based on a full standardized table with the policy duration adjustments. That's what it shows. Don't really like these steepening lines. We're only seeing this for 30-day experience. For 90-day accidents, that's not happening. And just quickly covering sickness, sickness doesn't actually trend at all, it stays quite flat. You ask me why this is happening, it might be quite controversial, but I'm going to say it's his product. And I looked at this and go, hang on, we haven't made any major product changes in the last couple of years. And you're right. Most of the product changes happened in the 2000s, maybe up to 2010, the major ones. There are things like day 1 accidents. Used to be day 7, day 14, now it's day 1 and day 3. You've got your waiting period requirements. Previously, you had to wait, disabled for 14 days in the waiting period, now it's 7 days. What all these things do to accident claims is it makes it so much easier for people to get their foot in the door. And that's what this trend is showing. So what I just explained was anything after 2010. Why does this thing keep increasing since then? Why is it 2011, 12, and look at 2013? It's the industry is just more aware of how our products work. They're more aware on how to structure our claims. I mean, one quick example, I've got a bad back. If I go day 1 and I have an accident, I can claim straight away. Sickness, I don't wait till the end of the waiting period. So I'll just go out to the garden, dig a few holes, and hurt my back. Now, so bring it back to the industry investigation. It was 2007 to 2011. Just think a very simple number. Midpoint 2009. That's where our experience is at. Look where 2012, 2013 is. The gap there. Is 27%. Now I'm using this red line, which is, well, I say it's a very rough guide. But for accident, which makes about half our claims, that's a calculated investigation anyway. That's a massive increase. And I'm just using this, I'm even ignoring the 2013 experience. When I use the actual experience in 2009, 2013, that 27 becomes 47. But some of us will go, hang on, that might be an outlier. I'm actually quite interested to know what happened in 2014. If I look at 2012, 2009, it's up 20%. They've extrapolated out, it's up 27%. So that's something you have to adjust for when we get the industry table. Because industry table is the average experience between 07 and 2011. And not only, so this 27 really only adjusted to the end of 2013. Is this trend going to keep going? It is. How far is it going to go and how high is it going to go? That's something we just have to make a judgment on.
I have a question now.
Oh, yeah.
This analysis, does it apply only to the reinsured part of the business, or is that
No, it's
only the reinsured part?
reinsured part. But we see every single claim in our investigation.
But you don't see the ones that are not reinsured with Munich Re for that same company.
Yes, so that would work when you have if you don't see every single claim, you only see the higher amounts. I would agree, because we see every single claim. But we can cover that off further in the Q&A if not helpful for you. So there are two insights for the incidents. Next one, I just quickly want to talk about termination. When I started doing this, my understanding was termination was the reason why we're making those losses. Back to that upper stats. Now, for investigation, that's not the case. Termination actually has been quite stable, and at the end I'll cover why I think that's happening. We're going to break this analysis up into first year and second, because they're different drivers. Okay. There we go. Thank you. Again, we're using our standardized table, and that's the trend we're seeing. Stays pretty flat. And what I've shown here is the aggregate year one across all our segments. In year one, there's your cause drives, your termination, your occupation, your wage group. All these things that we learn from understanding drivers, it all happens in year one. So look at accident and sickness. Let's talk about accident first. Accidents, if you remember what I just mentioned about accident trends, we've got more accident claims. Surely we should have more accident termination, especially this early duration. We're not seeing that at all, which we find was a bit surprising. I mean, at one stage we even put in some kind of trends to allow for it, but we actually looked into it deeper. Because we were adjusting for something we wanted to see, not what was actually there. So if I look at sickness by more granular durations, so 0 to 3 months, 4 to 6, 7 to 12, break out into 30-day, 90-day wait, different occupations. They all jump around a little bit, revolve around the long-term average. And that's the beauty of having a 10-year investigation. We understand termination are a bit volatile, and they do jump around. So I'm going to click to this 2-year now. It fluctuates a lot more. With R's are greater because we generally have less terminations after the first year. So we look at a 10-year view. I don't think there's a trend there. But imagine you only have a 3-year investigation, and you're the actuary trying to make sense of what's happening in year 2 termination, and you're at the end of 2000. You don't have the crystal ball on what happened in 2009 and onwards. I know what I would do. I think it's worsening. So if you take a long-term view, it's just you would reach a different conclusion. So going back to my initial comment when I talked about termination, why have we always thought that termination is a culprit? I don't think that, we think it's because of, it's this 25-year-old car that we've been trying to use and putting little adjustments to it. It's hiding what's actually happening, and it's getting slowly released, and we're slowly realizing things have changed, but I don't think that's what's actually changing if we actually standardize things properly. So there's 3 insights now that I've shared. Sickness incidences increase by policy duration, and it's worse by amounts. Accidents incidents have increased over time, while termination has stayed relatively stable. What should we do next? And on that, I'm going to hand it over to Graham.
Thank you, Wallace. So, I'm going to, having some interesting insights from Wallace, I'm now going to be talking about action. I'll start talking about some barriers to action, and then I'll conclude by talking about what we think companies need to do now. Start talking. Let me start with our measurement and understanding of profitability. DI takes a long time to work itself through. So for a particular year, you have claims, and then you have to set up reserves for them, and then you pay the claims over many years. And it takes a long time before you've worked out whether the profitability is...
Sorry, Graham, could you use the lectern? I don't think people are hearing it all. Thank you. Thanks.
Yeah.
Maybe just put the other microphone away. Thanks, Graham.
So, so when you're measuring the profitability of DI and your monthly profits, your annual profits, you have to calculate reserves, and the measure you're making is very heavily dependent on those reserves, which in turn is dependent upon the assumptions. In particular, if we go back to the termination graph that Wallace showed, we're definitely seeing anchor bias in assumptions. We're using an out-of-date table, probably looking back at historical experience, and therefore our reserving would not be reflecting that shape, and we're getting false profitability signals. Now, this has been something of a barrier to action. I guess appointed actuaries and those setting assumptions have to perhaps before they actually worsen the assumption, want to be confident. They may not be getting the proper signal anyway because it's a table, but then they want to be confident. So you get this creeping worsening of assumptions instead of a more full allowance. And that then feeds through to the market in terms of pricing. Naturally, companies will put prices up when their assumptions indicate so, but because of the lag in assumptions, we haven't seen the price changes. Now, let me talk about another barrier to change. Cross subsidies. So your company may feel, well, look, in fact, most companies might feel, look, we're not making the returns that we need to on our DI book, but overall, we're doing okay. We've got a lump sum profitability together with our DI is giving us what we want. Now, in stable times, when you've got a good grip on your profitability, that's probably a sensible thing, maybe a sensible thing to do. But times are changing. The type of information we've seen here, the industry investigation, the market will move, and it has started to move. Munich Re itself is putting up prices to its clients, and we've also seen a major company with a 10% rise, starting very recently, and another company with an 8% rise. So the market is moving. So have you considered the business mix risk you're running in these less stable times? The final barrier to action, the third one, is related to the others, first mover disadvantage. Now, this is not unique to DI. We've seen it in other places in the particularly retail risk market. But and you might feel, well, hang on, there's a bit happening, but not a lot. So we'll just wait and see. Just let me pose a question. Have you considered late mover disadvantage in a situation of change. You know, if you're late moving, you may well end up writing a lot more business of the type you don't want, and maybe even less business of the type that you really want. Because with cross subsidies, there could be pricing effects happening across products and not merely DI. So, the barriers to action that perhaps historically have been there, people might perceive them to be currently there. You need to overcome them, though they're not there anymore. Let me conclude by talking about what we think companies need to do. This is not rocket science. You need to go back and review your experience in the light of new information. We've had the industry study from 2014. We've had the information we presented here. You need to review your assumptions for both your pricing valuation, and you need to toss away the IAD table. The industry table hopefully is coming soon, and unless you've got something better, you should adopt that. When you've done that analysis, we think that you'll find you need to increase the price. No surprise. Now, let's move again. Price is the main lever for the existing business because you cannot change the terms and conditions. However, for new business, we feel there's a better way forward. So let me, with that, hand over to Alex, who's going to show us the way. Thank you.
Thank you, Graham. Now, as Brad pointed out, I'm not an actuary, but it would be remiss of me not to start with a number. So let me show you a number, and it is an exciting number. So first number is 35%. Now, this is the estimated claims cost savings that you could achieve out of the product changes that I'm going to walk you through in a moment. What we're going to do first, we're going to change the tack a little bit. We're going to do a role play. So before you all panic, don't worry, I'm not going to get anyone up at the front. But what I want you to do is just forget for a moment that you're an actuary, or that you're a product manager, or that you're in claims. Put that aside for a minute and just actually imagine that you're a customer. You've not had the insurance exposure before. You don't really understand the products. You are an end customer. You're Joe and you're an electrician. And you've had a friend that had a recent bad experience where they hurt themselves and they weren't working for a while. So you're like, I need to look into some insurance. So you go and see an advisor and he makes a recommendation to you, and as part of that recommendation, he hands over a PDS to you. And you look at that PDS, it's over 100 pages, you're flicking through it and thinking, I don't really understand any of this. There are words that I recognise the words, but I've never seen them used like this before, and it's not really making any sense to me. There's a lot of repetition, there's a lot of legalistic jargon, a lot of technical terms, and you're just not really understanding how it's being used. And it seems that there's a lot of fine print. There seem to be qualifying a lot of the statements that are being made to you. But you think, oh well, I saw the experience that my friend had, and I really do think it's important, so I'll take out this insurance. Anyway, a couple of years pass, and then one day you're on a building site and one of the boys leaves out a ladder and you trip over and you wound your back. You think, oh well, that's right, I've got this insurance policy. You see your neighbour and he says to you, oh, how are you going? Oh, I'm terrible. I'm totally disabled. Things aren't looking good. The insurer says I'm totally disabled. The doctor agrees I'm totally disabled. I'm really worried. I don't think I'm going to be getting better. You know, it's all right. I have this income protection policy. It pays me while I'm off work, so things are good. Even better, I can work up to 10 hours, and as long as I'm not working more than 10 hours a week, I can keep earning my income. So I'm pretty happy. Things are working. I've got the boys doing some of my sub jobs for me, and I'm just coordinating the calls and getting them out onto the job. So, you know, things are pretty good. I'm working fewer than 10 hours a week, and actually I've got my income being covered, so it's not too bad. Then you look at your friend and you think, oh, you had a bit of a bad back, didn't you? Have you got an IP policy too? You can see that the cogs turning over for him as well. Anyway, a couple of months later, you run into that same friend and they say, oh, how are things going? Oh, I'm so angry. You never believe it. The insurer tells me that they're closing my claim. They tell me that I'm no longer totally disabled. I mean, that's just ridiculous. You know, I'm totally disabled. They agreed with it, the doctor agreed with it, and they're now telling me that I'm not totally disabled. So they're telling me that they're going to end the claim. You know, I've been paying premiums all this time, and now they're not. They're going to stop paying me. You know, you just don't trust insurers. Okay, so you get a bit of a sense. Obviously, I'm exaggerating things there, but that's not an out of a completely out of the question experience for some of our clients. But so let's look at what we could be doing in the future. For me, I think it's vitally important that we use words that our customers can understand. So they need to be meaningful, so that so we can actually engage our customers on the journey, and they can actually understand. We can have a conversation with them, and they actually appreciate and understand what we're talking to them about. I actually think our definitions need to be more precise than they currently are. There's two reasons for this. One, it gives the customer more certainty. So it helps them actually understand whether or not they're going to be paid a claim. It just makes the process a lot easier for them in navigating something which is actually pretty unfamiliar and foreign to them. The flip side for us also, by having more objective and precise terms, is that we can price more accurately as well. So rather than having this funnel of doubt where the less or the more subjective our definitions are, the greyer our pricing assumptions are, obviously having more objective and precise definitions means that we can be more accurate with those definitions or with our pricing assumptions. Then I think we need to look at capacity. For me, the way we talk to our customers, at the moment we say, if you can't do one duty, you're in, you're on claim. And that just doesn't make sense. We should be talking to our customers about what can you do. So let's actually work with them and talk about, well, actually, you have this job, you might not be able to do that duty, but there's a lot of other duties that make up your role. What else? What can you be doing? And it's a much more constructive conversation to have with clients. Some of you might have heard of a thing called the health benefits of work. It's a consensus statement that was that's been started by the Faculty of Occupational and Environmental Medicine, and it's a really important initiative, which they're getting insurers and people from rehabilitation, doctors, a lot of industries, even trade unions are involved, talking about the benefits of work and that the impact that absence from work has, not just from obviously a financial perspective, but also from just the psychosocial impacts that can have work absence can have. So really talking about capacity is important as well. Then secondly, I'd say we really need to focus on recovery. What we tell our customers is important by the way we sell our products actually has a very subtle influence over them on what we're telling them to expect from us. So at the moment we focus on replacement of income. We say that's the important thing, that's the core part of this product that we're selling to you, is that we're going to replace your income if you can't work. How about if we change that and say actually why you're buying this product is because we're going to help you get better. So it changes the conversation completely and it stops this loss aversion that can be triggered if you're only focusing on dollar benefits. So we work with them and we say, right, we're helping you get better. Yes, we will replace your income. That's an ancillary feature of the product. But really, we're here to do whatever we can to help you get better. So the kind of strange thing we have about our products at the moment is that these psychosocial features that are actually designed to help people get better and go back to work are the things that we put into our extras packages and say, actually, you need to pay more to have that feature. They should be part of every single product. We should be doing everything we can to tailor our solutions, our claim solutions, to helping people get better. And then we have the policy terms, which most people will probably go to first. And definitely they are the tools that we use to manage the risks within our products. And obviously the things over which we have influence. But I would say that you can't just change one, you really need to be looking at all of these factors. But in terms of the policy terms, I'd be looking at things like replacement ratios. So we say we have a headline feature of 75%, but in reality a lot of the features that we have in our products mean that the actual replacement ratio at claim time is a lot higher than 75%. So I've talked about a couple of things here, quite a few, and they really centre around three key areas. So it's the language, so the words that we use to communicate with our customers. The value proposition, so this is the thing that we focus on and tell our customers is the core part of the product. And then the policy terms, so our risk management tools. And all of these give very subtle indicators to our customers about how we expect them to behave. So what I'd really like you to do is go back to the office about how you could actually incorporate these three elements into your products. So that ultimately for your new business, you can achieve a 35% claims cost savings and try and offset some of the pricing implications we've spoken about already this morning. And on that note, I will hand back over to Brad, who will summarise and lead us into our Q&A.
Thank you, Alex. In 2011, at Munich Re, we wrote down the value of our disability income book. And those of you who have had to do that, you know that you do it once and you do it right. Unfortunately, when we got to 2013, we wrote down the value of the book again. And we realised we needed to do something different to understand what was happening. So that led us to the experience investigation. It led us to stop using ARD, build our own table that we thought could bring out the real drivers of the cost. The insights that Wallace talked through, that came out of that review. And unfortunately, things are worse than we expected again. So that's led to Munich needing to take action, and we are taking action. So we're taking action on our own pricing. Alex has designed a product that we've put a lot of time in to work out how it can reduce claims cost. And we thought this session, sharing the information with you, was part of that. And now we think it's the industry's turn to follow. We think that inevitably companies will need to look at their reserving, will need to look at their pricing. And what we suggest is take what we've shared today, look at the insights in your own analysis. Certainly pick up the FSC table when it becomes available, hopefully in the next month or two. Remember, it's already 5 years out of date, so you have 5 years of trends to adjust it. And we think inevitably, by doing that, you'll come to your own views about what you need to do with reserving, pricing and product. That's it. Thank you for listening. I think we'll now be happy to hear any questions. Anyone want to start?
Is the microphone on?
So there's Mike's in the roof, so if you just
Hi, Jeff Humphries. So I'll just start with Brad. Thank you for that. It was very, very good. One of the numbers you quoted up front was this product has an expected loss ratio of 50%. I think in there is your problem, because if I'm a consumer and I give you $1 in premium, my expected return is 50%. You've got a real problem, and once people realise that their expected return is 50%, they start opting out. So all your duration effects, all those sorts of things are just the healthy lives dropping out, and they realise it's not value for money. And you haven't addressed any of those issues of value for money for the consumer until towards the end. That's I think, the key problem with DI. And you'll increase premiums, you'll get another drop out of healthy lives. So I don't think your premium increase is the solution. I think you've got a lot more fundamental problem and you haven't addressed it.
So you raised a lot of things there, Jeff. Look, I think essentially that is our view. We think that we need to relook at the whole product and how it works going forward. The reality is a lot of us and all the direct companies here do have a big book, and because we can't change the product, we can't go back and pass back worse definitions, we are left with price as really the only lever. And so that is absolutely a challenge. How do you fix up your back book? But yeah, absolutely, there's challenges on the front book as well.
Sorry, Claire. Do you see a trend of maybe just changing the product to be just an income replacement based on your current income rather than a income as at your underwriting time? Because sometimes someone like a business owner could easily earn a lot of money over 5 years and then and then drop out with their income dropping out, and then you will have a disparity in terms of insuring more than a big more than 75 or more than even 100% of your income over time. That sort of gives people the incentive to kind of stay on the claim and those kind of things.
Yeah, that's a really good point. Replacement ratios is one of the significant things we've found that impacts the pricing. So yes, we're looking at that ensuring that you're basing it on the income closer to when you claim, so that it does make sure that you're not necessarily cherry picking a much earlier income. I mean, even some of our existing products have limited capacity to alter adjust benefits on agreed value, even if you didn't tell us the right income application. Unless you are able to go down the non-disclosure remedies, which can be quite limited in a lot of circumstances. So the new product design does look quite a lot at replacement ratios, and particularly that issue.
And do you see the insurer taking on more of a claims manager, or what do you call that, like a rehabilitation and wellness management kind of role going forward with the new product, and rather than just paying claims? And
I think a lot of it comes down to the communication style. So we already do great things in the claims space. So I think a lot of it comes down to how we actually position that with customers so they're on board. I don't think, a lot of companies do have in-house rehabilitation, but I'm not suggesting that everyone changes how they're running their claims departments at the moment. But being very good at coordinating that and actually helping clients make sure they can access the necessary services, so not necessarily providing it as the insurer yourself, but making sure you can help clients access that, because we often have a very unique view where we can see the GPs and the specialists and the rehab providers that they're going to, and those parties aren't always communicating with each other as best they could be. So there's definitely opportunity there. I do think the way we kind of coordinate and communicate that with our customers is a big opportunity.
The topic of a trend, I think, is quite critical in the DI experience. I think you mentioned, Wallace, how do you, I suppose, avoid seeing a trend or believing there's a trend when you're just eyeballing graphs? Was there a statistical test you sought to get validation of the trend? Then my second question is, how much further will the trend go beyond 2013? And so, in fact, it's a 20% premium increase just to get us to 2013, but there's another 3 years of trend. Should it go even further than 20%?
I'll answer that second part first about how long the trend goes on. Our industry is a YRT business, so we can reprice whenever we need. And if all we believe is awareness issue with the accidents, then we need to keep monitoring what happens, but we don't have to extrapolate the trend too much further, because we already have that ability to reprice. I mean, if it's awareness, it's kind of very hard to pin down when it's going to stop. It's going to keep monitoring. And that's why I said 2014 were very interesting. Is 2013 a blip, or will it come down slightly? And so I missed the first question.
How do you resist falling into the temptation of seeing graphically a trend when in fact there's not a statistical trend in the experience?
So we try using the confidence intervals that I've had in the graphs, and there's also some principles. If it's 1 year increase like accident on 2013, we're not going to rely on a change in 1 year's worth of experience to form a different view. We need something that's long term. And then I guess there's two aspects of this. One's the within period trend, what we actually do see, the 2004, 2013 experience. The other one is it's not as judgmental as actually what happened. It's what you extrapolate beyond 2013. Now, that one, we need to have a rationale why we believe that trend will continue. So, for example, our one is the awareness. If there's no product changes, or most of the product changes have continued from 2010, then and it continued happening for the last 3 years, it's probably likely to continue going further.
Good question. Are you willing to share your analysis with one of your insurers?
So we are, and we actually have been, one of the difficulties now is actually common language. So all the direct companies talk in IAD language, and we've thrown it out. So we've done a lot of converting our stuff back to IAD, but it hides some of the trends, it hides the duration.
I'm happy you can throw out the IAD. Who can't talk to?
So you can talk to any of us. In a minute we'll flick up our email addresses, so feel free to get in touch with any of us.
Hi, Ronald Blood from Tau. I just like to qualify my questions by stating I am a group pricing actuary. I have 3 questions. The first one is in relation to your early statement about the market has done virtually nothing in the last 5 years. Now, I am fairly surprised by that statement. I would like insurers in the room to qualify that. That would be great. And partly my surprise comes in 2 reasons. One is, as you stated, the deterioration experience is not the first time we know about it now. We knew about it a few years back. The other thing is understand every insurer or most insurers in the market do something like half-yearly or annual upgrade to their product. So now there might have been 10 times they have upgraded the products and yet they have done nothing. No one. So yeah, no, it's just a surprise to me. Now my second question is then, okay, say yes, nothing's been done, then there's got to be some really strong reason to why they have not been done. So now if we understand why they have not been done, that probably put us in a better place on what can really be done going forward. So yeah, I'm interested to know, okay, so given we haven't done nothing, why do we think we can do something going forward? And what can we really do? And my third question relates to the value proposition about the advisors. We talked about making the PODOC or PDS better documents. What about the value of the advisor and the change? The asset report saying no more upfront commission. So how is that going to affect the market going forward? Yeah, so just some questions around that.
Okay. So if I go back to the first question, which I think you're essentially asking is, why haven't we been doing anything? And there's certainly a lot of companies represented here, including a couple of product managers, so they might like to add a comment if they feel like it. But having worked at a couple of direct insurers up until 12 months ago, I know very well the pressures of the market, that if your product isn't rated high enough, planners don't sell it. If it's not priced well enough, planners don't sell it. So there's this incredible pressure to keep your product updated. So as soon as one company makes a change, you've got to match it, otherwise your sales drop. And so it's clearly not working well from a profitability point of view. My own view is the way to cut through it is to really understand your analysis. Certainly from where I've driven, it's actually the appointed actuaries who've had the best cut through, where they say, this is the experience and we have to do something. And so what we're sharing today is part of that, and I'm sure the FSC table, when it comes out, will add to that. It will increase our knowledge, and I think that will shed a bit more light and hopefully start to break the cycle. The third question, I think, was one for Alex, and I forget the second question.
Good point about advisors. They're obviously, in terms of the retail product, they're fundamental to the distribution model. So there's 2 parts to it. One is engaging them in the development process. But when you ask advisors what they want, a lot of times they are fairly constrained by what they know. So they'll give you answers within the box of what they do know. So I think there is a big piece of education and taking them along the journey to get them on board with the new proposition. We've also spoken to research houses about, or at least initiated those conversations around how this product might be represented on research houses, so it's not just a low rating that, again, advisors are just going to go, well, like that's a 60 compared to a 98, why would I sell that product? So there are a lot of factors. I certainly haven't waded into commission because that's a bit of a moving field at the moment, so I've kept that piece to the side. But yeah, advisors, important.
The second question was?
I think to touch on the second question. My first question was, why hasn't the market done anything in the last 5 years?
I think that's for the same reasons that I've talked about. One, are we understanding the analysis well enough, the exact position, and two, the pressures to continue to build the product and pricing so that you sell.
I was not actually Brian, I'm currently at APRA, but I prefer to say this as a previous chair of the Morbidity and Mortality Committees of the Institute of Actuaries. If you bother to go and read the reports that we used to write, if I dare take Leonie Tickle's name in vain, I know she's here. She used to do lovely cause of claims analysis until she said there's only 5,000 causes for 35,000 claims, it's not worth doing. And that was over 15 years ago. Slowly we are starting to see the industry getting to a reasonable point of data. They can start to understand what an ancillary benefit costs. They can start to identify, and we are seeing some companies are looking, at least in the sensitivity analysis, that selective lapsation is a possibility, not an inevitability. So the industry has been very slow in learning, I think. I think the trends are much bigger than they're seen because there are things still hiding them. I think the group industry should be very, very frightened because what you're showing in your claims analysis is early intervention, good interaction with the claimant is what's needed to get good claims experience. And in industry funds, you have anything but that. You have the latest late notifications, that sort of thing. The one biggest change that's happened, which was only mentioned in the tiniest little bit, is underwriting standards. We have the most generous underwriting standards in the world. And underwriting standard changes take, hopefully, a long time to come through in your claims experience. If we're continuing to stretch our underwriting and allow less healthy lives in without underwriting and loading and excluding them, then you can expect your claims experience to continue to get worse. And I haven't yet seen a company that prices their disability product in isolation of their lump sum product, but the portfolio is acceptable for their benchmarks.
Thanks, Anthony. One of the things that I find quite interesting, if you go and talk to the direct companies and ask them what are you doing, they will inevitably tell you all the stuff they're doing on claims, which is great. We need to do it, but it's treating, if you're itchy, it's kind of like scratching. It's not treating the cause. So yeah, I agree with that. Right?
So go back to the last question when I was on the insights.
I wonder if you could put up the slide that you showed at the table. The first slide. Let's say these are the drivers and this is your data.
Yep.
So I have two questions. Yep. One is the one I asked already. So are we looking at reinsured part of the portfolio? So these are all reinsurance policies, or are you looking at more than just that, right? That's the first question. Yep. The second question is, what's in the others? Are you happy to share what's in the others, and what have you considered and discarded, and what have you considered and used?
The first question, is this the reinsured, what Munich Re actually pays? It is. Yep. But what we pay, we see every single claim, so I didn't answer that question earlier. The second one is, what's in these others? So I'm just going to talk about the incidents first. For smoking status, there's smoking status in there. Smoking status, we didn't see, after cause, waiting period, occupation and gender, smoking status don't vary the age that much at all. It's actually quite stable by age. Now the other one is, so covered off knowledge duration. Another one, which is termination, it's benefit period. Benefit period, for instance, doesn't make a difference. And a lot of these things aren't that surprising. Whether you claim 65 or 2 years, it shouldn't affect your incidence. For termination, it does make a big difference. And over the claim duration, as you keep going further and further, your benefit period has a bigger impact. So they start diverging. So the longer, like the lifetime benefits, they would get worse and worse terminations as you move along the duration curve. But for the shorter ones, it actually gets, well, compared to a 65, it gets better and better.
One question on this from Jerry. Cause of claim you mentioned here as a driver, but I'm surprised that the entire presentation I didn't hear the term mental disorders or mental illness. Is there nothing to say? Didn't you observe anything? Or is that all in this?
Well, we didn't say
35% there.
No, we didn't specifically look at mental disorders because there's still limited volume of claims. So we wanted to really classify accident sickness. You ask for a personal preference, or would love to have a basis, like stated table that does these causes in more detail. With the limited analysis we did have for mental disorders, that the incidence wasn't really changing. But for termination, they have about half, across accident sickness termination-wise, it's about half the termination rates compared to an average one. But we didn't look at the mental disorders.
A lot of your graphs, Greg Martin, a lot of your graphs I noticed seem to have little turning points at, say, 2006, 7 or 7 years ago, same place. I think we shouldn't forget that this is an economic cycle affected product. And there was, I've been in this industry with this product now for 25 years, and there's been about 3 or 4 surges over time since the late 80s, 93, around that period, late 90s. We had lots of losses in the early 2000s. China came along and saved us to an extent. And if you actually look at some of your graphs, there's actually hints that 7 years ago the trend was going the other way. A lot of people thought it was. I think I'd be very interested if you use some economic sort of correlations in here, because actually it gets back to James' point a little bit. I think there's some economic stuff, but I suspect it will get a little bit worse for the industry because RBA is putting interest rates down at the moment for some good reasons. But then, maybe if the dollar keeps going down and some of the housing sector and professional sectors actually get a bit of kick up, I think accountants are being re-employed again. For all you know, you might actually find it goes a little bit differently. But to my mind, one of the problems is the whole industry is still pricing on a boom time economy. And we actually have got through our heads that we're actually not in a boom time economy, we're in a normal economy. And the price should go up 20% because it was just 20% cheap 6, 7 years ago. That's all there is to it. The other thing I think is, it's all very nice to have all these ideas, Alex, but until everybody actually puts their prices up to charge the right price for what we've got, it's very hard for any entrants to come into the market and charge a fair price for something that's cheaper. Otherwise, you're coming in charging the same price as the rubbish for the good product. You're not going to get any traction because what's any advisor on best interest duty going to do? They're going to sell the thing with all the bells and whistles for the same price. Why wouldn't you? Anyway, sorry.
I don't think any of us here actually disagree with what she said.
Was there any discernible material difference across seeders? So just, is there a sort of a bottom to a top performance across seeder level relative to the overall portfolio you're observing?
So accident trends, they all are moving that direction. Some of them go up early, it flattens it slightly, but they all slowly drift towards that higher end.
So not a huge difference. You're saying no. Bottom to top across seeders. It's all pretty.
So that's something we had to make sure that our trends isn't influenced by one block of business.
Thanks for the presentation, Lindsay Smart. I thought one of the interesting graphs was the incidence rates by duration, and I think it then got steeper, no surprises when you put it into dollar terms rather than number terms. And so have you turned your minds to what really to do about the selective lapsation issue in the YRT market that I think that graph is really describing?
So I think, Lindsay, the question was, have we turned our mind to the YRT market and how we can essentially improve lapses so that we minimise selective lapse?
How to deal with the selective lapse issue, which is very frank on that graph.
We've certainly discussed it and debated it, but I would say we don't have a solution. We think getting the prices right so that you don't have to keep putting increases through time after time is essential part of that. I think some of the debate on the commission, with level commission, where that's heading potentially helps. I know there's various companies rethinking about step first level premium or something in between and how that might impact it. Is there a silver bullet? I don't think we've come up with one. And I think we just need to keep pulling the levers that we know can help.
I think you need to be a bit careful on this selective lapsation thing because of the economic cycle stuff. And in particular, this business is also affected, as you guys said, by income replacement ratios. So people that took policies out 7 years ago on bigger incomes than they've got now, whether it's indemnity or free value, doesn't help with the fact that you're going to have higher claims rates on policies that are 7 years old because of the income replacement ratio and that sort of issues as well. So I think the selective lapsation stuff is really complex to understand how much of it is that and how much of it is co-mingled in with economic conditions and all the rest of it. But economic conditions have, to my mind, actually, they might have appeared to have been a bit worse just straight after the GFC, but they weren't, because there was fear and loathing and people really held on to their jobs and turned up and smiled and did anything so worried about losing their job. Now, life's just tough. And, this is another way out. So, I'm just saying, you've got to be really careful about jumping to some conclusions with this stuff.
Just to counter that, we're all talking about churning. We're all looking at how advisors are replacing policies. The average duration of a policy is far less than it ever used to be. That every economic cycle, we've never returned back to the goodness of the boom time because terms and conditions have got easier, underwriting's gotten easier, less offsets. So the economic cycle may explain part of it, but each time we're giving ourselves a bigger problem.
We're getting on close to 1:45, and if you like us, you probably have 2 o'clock meetings to get to. So I'll flick to the slide, whoever's got the clicker, right to the end with our email address. So we're more than happy for anyone to get in touch while Alex is doing that. Violet, you look like you have a question.
I don't have a question, I have a comment if it's okay to make. First of all, thank you to Munich Re for sharing this information. A lot of the findings are very consistent with the FSC investigation. As you know, you've read the reports cover to cover, you know that they're very consistent. Secondly, I want to say, because there are so many actuaries in the room in one time, and you all invest in insurance, what's missing here and in the FSC investigation and in Australia is that we're not capturing data for very important things like salary, underwriting, how we underwrite people, and things like that. And even thinking about mental illness claims and whether we can reserve by mental illness or not, you need to then be confident that you're classifying claims correctly as a mental illness claim. So what we're missing as an industry, as an action, and we're actually waiting for Munich Re to tell us to do this, is that we actually need to think a lot harder as an industry about what we need to collect data and to actually track experience by those. Because overseas, there are at least 3 or 4 very big drivers that are still missing in all of our collection of data and in all of our PASs. So that's my comment. Thank you.
Thanks, Far. I think we're very much in agreement with that. We have passionate debates on data at Munich Re. So I think we'll wrap it up there. Thanks for coming, and